Should you buy in this higher interest rate market, or should you wait until interest rates drop and then hop back in and purchase your home? We'll go over the pros and cons of buying in a higher interest rate market versus a lower interest rate market. And then hopefully by the end of this video, you'll have enough information to decide what you want to do and how you want to move forward. So we'll get into it here shortly. Really quick, my name is Anthony Campos. I'm a licensed real estate broker here in California and in Texas, where we help families buy, sell, and invest real estate. Anyways, we'll get into purchasing in a higher interest rate market versus lower interest rate market. So we'll start off with lower interest rate market. So obviously, when you're purchasing in a lower interest rate, the pros are your payment is going to be a lot lower. The total amount of interest that you're going to pay to the bank is going to be a lot lower. And you're also going to be able to qualify for more. The way that this works is the lender is actually going to qualify you based on debt to income ratios. And debt to income ratios are basically what it's basically saying is debt to income. They'll look at your total monthly income, and then they're going to take your total monthly debt payments, and then they're going to include your new housing payment on there. And they typically want the total monthly debt payments and the new housing payment to be about 45 to 50% of what you're bringing in your total monthly income. Depending on the loan product that you're using and your situation, it's typically 45 to 50% of what they're looking for. So with a lower interest rate, because your total monthly housing payment will be lower, you can stretch the budget a little bit more if you wanted a higher purchase price. Those are the pros. The cons of purchasing in a lower interest rate market is that because everyone else is going to have a stronger purchase power, the market is going to be a little bit more competitive. Currently, we're dealing with a inventory shortage. So once we see rates drop, we're going to see some buyer demand come in. And if the inventory can't keep up with that buyer demand, typically what happens is if there's not enough supply and there's more demand, the prices will increase, right? It's kind of just standard supply and demand. So if that happens, you're going to see more competition, which means if you're in the market at that time, you may not have a higher likelihood of getting the actual home that you want. I mean, it's a possibility, right? If more people come in, it's less likely for you to get the actual home that you want because there's more buyers now bidding for that home. So one of the cons are more competition, which the second con would be, which means you won't have as much options for you to choose your home. The third con will be if you do decide to purchase your home at that point and you don't mind, overbidding and overpaying for a home, because if there's multiple offers on there, you may need to put in an offer higher than someone else's. So if that happens, the other issue then comes into play of if the property doesn't appraise. So we'll go through a quick example. You're out touring homes and there's a home for sale for $600,000 and it's turnkey, beautiful, ready to go, but your real estate agent lets you know there's multiple offers on here. So you guys decide to overbid or put an offer that's over asking. Let's just say you go $625,000 and you win the bid, you're in escrow, you're under contract, and you're doing your inspections. Typically with your loan, you're going to have a appraisal, and the appraisal is going to dictate the value of that property. So it was listed at $600,000 and you're locked under contract for $625,000 with the seller. So now the appraiser will come out to the property, and what they're going to do is they're going to look at the subject property, which is the home that you bid it on, and they're going to look at a half-mile radius of that area, and they're going to look at all the solds, pendings, and active homes from the last 180 days. And if they can't find any properties that support the value of $625,000, which you are currently locked up under with the seller, then they may come in at $600,000, right, of supporting that price. So now you have a $600,000 appraised value and a $625,000 purchase price with the seller. So now you may have to come up with that difference. Now there's options where you will be able to negotiate with the seller and reduce the price to $600,000. Then you're done, you close the deal, and you're getting to your home. The other scenario is that you try to negotiate with the seller, and the seller says, no way, I want my $625,000. Now you'll have two options. You can either bring in the difference of $25,000, which would be on top of the closing costs that you already have and on top of the down payment that you're bringing in. So more cash to close to bring in, or you can cancel and move on to the next property. So the cons of being the last con of purchasing a lower interest rate market is that you may overpay, which means you may run into appraisal issues. And if you run into appraisal issues, you may have to bring in more money at the close of escrow. If the cash in your bank account is kind of tight, then you may want to consider or reconsider your options or the path that you're taking now. So those are the pros and cons of purchasing in a lower interest rate market. Now we'll look at a higher interest rate market. We'll look at the obvious cons. Total monthly payments a lot higher. Already, that's horrible. That's why people are holding off, right? They either don't want the higher monthly payment or they just don't qualify. So higher monthly payment, first con. Second one would be that you're going to be paying more interest over the life of the loan versus if you bought with a lower interest rate, obviously, right? You're going to be paying more interest to the bank. And the third con would be that you may not be able to qualify for as much home as a lower interest rate. So when we go back into the debt to income ratios, because you have a higher interest rate, that means your payment will be a lot higher, which means that your debt to income ratios may exceed of what the lender will actually allow you to do. So if you wanted a specific home at a specific price, you may not be able to afford $800,000 in a higher interest rate market, but you may be able to afford it in a lower interest rate market. Just depends on your situation. So those are the obvious cons. Now we look at pros, which is there's less competition out there. Less people are willing to buy in a higher interest rate market because of the cons I just mentioned. Less competition then means you have a better opportunity to negotiate price with a seller. You could negotiate seller credits from a seller, which can help you with your total cash to close. Or you can use those credits to help you with a interest rate buy down, whether it's a permanent rate buy down or a temporary buy down. So those are a few pros there that most people are not really seeing right now, and is something that we are talking about with our clients, because a better strategy can be, instead of risking once rates do drop, and you can go that route as well, but it's pretty likely that that's what's going to happen once interest rates drop. So you can maybe get a price reduction, get some seller credits now, get into your home, close in your home, be comfortable in your home. Once rates drop and everything gets crazy, you can then refinance into a lower rate and not have to be out there in the craziness. So hopefully this was helpful, and it will allow you to make a decision on what you need to do. If you like this type of content, drop a comment and let me know, and I'll talk to you soon. Take care.